Welcome to Facts Pro, where it's all about facts, financial, accounting, and tax strategies. Today, we talk again about another tax strategy that can help us save on taxes. It is somewhat related to what we talked about last week because last week we were talking about some like strategy related to donating or related to like donating appreciated land or appreciated piece of property where it wouldn't be considered just an investment, but when we want to donate an X amount, but uh, uh, in return, we take 5x deduction on our tax return to get the maximum tax benefit. All right, and we talked about like who would this be suitable for, what are the risks and consideration that we have to bear in mind. Today we talk about another one. It's also related to donating. It's a little bit different, but we'll dig in and you probably heard of it, but we'll try to simplify it in very simple terms. All right, what am I talking about before we'll dig in and before I tell you what we're talking about, we usually share a joke, as you know. So this is about somebody who hates paying income taxes, and they say you should be a good citizen. Why don't you pay with a smile? So I'd like to, but they insist on money. All right, so. What am I talking about? I'm talking about the advisory donor advisory fund or DAF. What's a donor advisory fund and how can this be a smart tax strategy for high earners to save on taxes? Let's try to simplify the matter and explain it in a very simple term. All right, so what's a donor advisory fund? This is a charitable investment account for supporting charities. So you're someone who usually send donations to supporting charities, and we know that if we want our donations to be considered tax deductible, and that's of course if you're itemizing your deduction, it has to be recognized by the IRS as a charity. You can contribute cash, security, or asset to any charity that you like. But in this case, you have a or a big tax bill and you want immediate tax deduction. So this is where you go for the donor advisory fund where you put in X amount where you take immediate tax deduction for it and you specify what charities that you want your funds to go to. You're the one who recommending the grants to go to charities over time. So instead of donating, or instead of like, uh, and that's some like scenario that works with some people that they donate X amount to these like charitable organizations in 1 year, but they don't take the benefit of it uh, for multiple reasons. One reason that they may not be itemizing deduction. Another reason that they have a limitation on of AGI, so they carry forward. They don't take the whole thing, or but in this case, what we're talking about today is that you're gonna donate X amount, you're gonna multiply it all in 1 year. So you're kind of like you're paying it in advance. You're taking the tax advantage in 1 year, and then you're paying the charities over multiple years. And instead of sending it from your checking or saving account, you're sending the donation from an investment account called the donor advisory fund. But when do you take the deduction? You don't take it when it goes to the charities. You take it when you put the money into the donor advisory fund. All right? Okay, so the key benefits here that you take the immediate tax deduction, you don't wait until the money actually goes to the charity. You take the deduction when you put the money in this investment account. The assets grow tax-free, so you're not paying any taxes on any interest, dividends, capital gains, and it gives you flexible giving schedule. and there is a very simplified record keeping. So those are the key benefits of this. Who can benefit the most? Definitely high income earners. So if you're a doctor, you're a business owner, this is for you. If you're facing a large taxable event, so you're selling your business, you got a bonus, you got like a very high income year for whatever reason, then this could be a strategy that you should consider in this year. Individual with appreciated assets. So you have an asset that have appreciated in value, and if you sell it, you would be subject to capital gain. So instead of selling it, paying the capital gain and then donating the cash, how about donating the asset if in its appreciated value, so you avoid the capital gain. And this is definitely for those families who focus on legacy giving and who giving is one of their like their focus and their interests. Okay. All right. This is just to give you an example. If you sell 200,000 appreciated stock, you pay capital gain. But if you donate it via the donor advisory fund, you put in the 200,000 right away, you avoid the capital gain and you deduct the fair market value of the appreciated stock. So if you bought the stock for 100K, but now the value of it is 200K, you take the deduction for the full 200. So instead of paying like $30,000 plus on taxes, you get full $200,000 in tax deduction that goes to the charity. So definitely reduce your taxable income immediately, right away. All right. Okay. Here, the strategic uses of the donor advisory fund. First, you bunch multiple years donation to exceed the standard deduction. So again, as we said, and instead of if you're not using if you're not benefiting from the donations that you make to charities because you don't have maybe a mortgage, or if you don't have or because of the cap on taxes, or because of whatever reason, then you bunch multiple years donation in 1 year to exceed the standard deduction, and you take the immediate tax deduction. Two, you offset the income spikes, as we said, if you have a bonus, practice sales, stock windfall, anything that had your income spike in 1 year, then you offset that with the donor advisory fund. And it's best when you combine it with charitable trust and gifting strategies, as we have mentioned in other times. And we will also maybe talk about it in another time, like charitable remainder trust and other stuff like that. Okay. Things to consider, that the contributions are irrevocable. This is not something that you can say, okay, I changed my mind about. No. You must give to qualified charities that are recognized by the IRS as so. You cannot use the funds personally, so we don't want to do any shady deals here. Grants are subject to sponsor approval. So the sponsor that you put in the money with have to be approving the grants. Okay. This is another case study, a doctor example. Dr. Smith earns like 900,000 a year. He wants to give 100,000. So instead of giving $100,000 in cash, the strategy is for us to donate appreciated stock. He has appreciated stock, so we tell him, okay, donate the appreciated stock so you can avoid the capital gain, and you also take the deduction of like $37,000 when you put in the money into the donor advisory fund. And instead of donating 1 year, you can now choose to spread the donations over 5 years or whatever number of years if you choose to. Okay? And whatever organizations you choose to as well. All right. So why the donor advisory fund versus the direct giving? As we said, because you get the immediate deduction without even without a chosen charity, like you get it and then you can choose it. There is a tax efficiency with appreciated asset, as we said. And instead of donating cash that you pay taxes on, you donate assets, appreciated asset to avoid the capital gain on. And legacy planning with family involvement. Final takeaway, the donor advisory fund lets you give smarter. So you're giving anyway, but we want you to give in a smarter way to maximize the tax savings today while supporting the causes you care about tomorrow. All right. So again, this is my contact information. If you have questions about the donor advisory fund, if it's a good strategy for you, you don't know how to set up one, you don't know where to go, please feel free to like join me on a 30-minute consultation and we'll talk about it to see if that's the right strategy for you. All right. Thank you so much and see you next week.